Hi, this is Nicholas Vardy, and welcome to this week's edition of Buy or Buy. In this series of videos, I take a popular stock making the media rounds and I strip away all the hype, and I tell you whether you should buy now, buy later, or buy never. Today, I want to take a look at the big cheese of entertainment stocks, or more specifically, the big mouse, which is Disney. A stalwart in the entertainment sector, Disney has seen some negative press on practically all fronts. Earnings missed expectations, streaming growth has slowed to a crawl, and theme parks are also struggling with falling margins. Disney shares plummeted 7% on November 11th, their worst session since June of 2020. The stock was the worst performer in the Dow Jones Industrial Index. Its losses put it into a bear market, having fallen more than 20% from its March peak. Multiple Wall Street analysts actually cut their target price on Disney as well, down to $180 to $200 per share. The question is, after dropping 13% this year, is this a sign of a long-term decline in Disney, or is it a chance to grab a premier blue chip at a substantial discount? As always, let's start with the numbers. Disney missed Wall Street forecasts in Q4 despite swinging back to profits from the depths of the COVID-19 induced recession. Disney's total revenue in the quarter came in at $18.5 billion. Now that was up 26% compared to a year ago, but it was below analyst expectations. Adjusted earnings per share came in at 37 cents, missing by 12 cents. The headlines focused on the streaming challenges of Disney Plus. So let's take a look at that topic as well as some other challenges that this American icon is facing today. So let's start with theme park attendance. The past quarter marked the first time since the pandemic started that all of Disney's theme parks were open for the entire quarter. Park revenues of $4.17 billion topped analyst estimates of $3.96 billion. Walt Disney World attendance grew by double digits, while per capita spend increased by roughly 30% from fiscal 2019 levels. Still, operating profits fell far short of expectations, and international parks experienced losses as well. Now, that's because fewer people are allowed to go to these theme parks as a result of COVID-related safety precautions. Overall, the margins at Disney Parks, Experience, and Products came in at a little under 12%. Now, that was well below pre-COVID levels. Overall, this means that Disney will have to work on its cost structure to restore early levels of profitability. Still, a return to pre-COVID normalcy is really the key to a sustained rebound in this area. And that normalcy is really just a matter of time. Second, Disney highlighted the challenges of inflationary pressures. First, hourly wage inflation at Disney has been substantial, along with many other employers in the US. Second, the cost of goods has also soared. Finally, there's intense competition for content in the streaming wars for Disney Plus. Because of the competition for talent, everything in production, content-related costs have gone up. Let's take a closer look at the Disney Streaming Plus business. This quarter demonstrated that the biggest stock catalyst, streaming growth, will not move in a straight line up. Disney added only 2.1 million subscribers, reaching 18.1 million around the world in the past quarter. Now, that growth is actually sharply lower than in the previous quarter. In announcing the results, CEO Bob Chapek sought to downplay the miss, touting the streamer's 60% growth rate year on year. Now, Chapek portrayed the lower than expected subscriber net adds as a hiccup on the way to Disney Plus hitting its target of 230 million to 260 million subscribers by fiscal 2024. Disney blamed content production delays for the Disney Plus slowdown. Disney actually has 340 pieces of new content in the Disney Plus pipeline. That's a remarkable number. In Q4 of 2022, Disney Plus will release originals from all of its major brands: Disney, Marvel, Star Wars, Pixar, and National Geographic. But what is Disney's perhaps biggest challenge? Much like the film studios in the early 2000s, there are just too many streaming options for consumers. Competition is fierce, and some providers like Disney have divided their assets into multiple applications like Disney Plus, Hulu, or ESPN, all Disney properties. It's become less and less possible for consumers to own and use every single streaming service. In fact, I'd like you to comment below to tell me how many streaming services you subscribe to and how many you actually use during an average week. As I say, I can never predict the future, but I can say with confidence that anytime there's a sharp sell-off in a blue chip stock like Disney, it is generally a good time to enter that position. That's because investor narratives change with time. Today's bad news is long forgotten. As John Kenneth Galbraith famously observed, the financial memory is very short. So my verdict, Disney is a buy for patient investors. Despite its current challenges, Disney isn't going anywhere. Fast forward to 2023, and the current hiccup in the stock will be a distant memory. Yes, there is a resetting of expectations for Disney, which has traded at a hefty premium to its peers in the entertainment space, but I believe that negative investor sentiment on Disney will prove to be transitory. If you own Disney, you can hold on to it, but don't expect much until the narrative changes. But if you don't own Disney, this is a good time to build a position in this premier blue chip stock. I hope you enjoyed this edition of Buy or Buy. If so, please hit the like button below. I want to remind you that these are not recommendations that are actively tracked in any specific model portfolio. If you want to follow any of my buys or sells, size your position accordingly, set a trailing stop, and never bet more than what you can afford to lose. And if you would like some more financial insights on stocks, trends, or money in general, be sure to sign up to Liberty Through Wealth, a free e-letter I contribute to at the link below. Thanks for watching, and I'll see you next week on Buy or Buy.